Hey everyone, and welcome back to the Safe Simple Sound podcast. I'm your host, Alex. Here at the show, we are constantly focused on the you in our secured framework, understanding financial choices. And for many of you listening, especially those in the squeezed upper middle class, there is perhaps no choice more complex or more expensive than sending a child to college. Today, we are diving deep into a topic that keeps many parents up at night: the confusing world of college pricing. We're drawing insights from a fantastic, detailed article titled FAFSA versus CSS Profile: Why the Same Family Gets Different Aid at Different Schools. This article reveals a stunning reality. Your family's financial need isn't a fixed number. In fact, your expected contribution can swing by over $40,000 a year, depending entirely on which financial aid form the college uses. The piece highlights how financial aid for high-income families is often a negotiation, not a calculation, and why owning a home or a small business can radically change the price tag of a degree. If you are looking to create a financial safety net while navigating the college admissions process, this is the episode for you. Let's get started. I want to zoom in on something that catches so many parents off guard. We tend to think of financial need like a medical diagnosis. You go to the doctor, they take your temperature, and the number is the number. You have a fever or you don't. But in the world of college funding, financial need isn't a fixed number. It's an opinion. And that opinion depends entirely on which rulebook the college is reading from. This brings us to our next major topic: the two rulebooks, federal versus institutional methodology. Here is the reality. There is no universal system for calculating what you can afford to pay. Instead, we have two completely different formulas, and understanding the difference between them is the single most important factor in predicting your final price tag. First, you have federal methodology. This is the standard formula mandated by Congress. It uses the FAFSA, the Free Application for Federal Student Aid. Every public university and many private colleges use this. It's public, it's standardized, and frankly, it's a bit of a blunt instrument. Then you have institutional methodology. This uses a form called the CSS Profile. This is used by about 250 of the most selective private colleges. Think the Ivies, the elite liberal arts schools, and the prestigious heavy hitters. And unlike the FAFSA, the CSS Profile is customizable by the college. Let me give you an analogy to help this sink in. Think of federal methodology, the FAFSA, like filing your taxes with a 1040EZ. It's streamlined. It asks about your income, your bank accounts, and your investments. It's pretty black and white. On the other hand, institutional methodology, the CSS Profile, is like getting audited by a forensic accountant who is convinced you're hiding gold bars in your basement. While the FAFSA asks about 100 questions, the CSS Profile asks closer to 400. It is invasive. It digs into everything. Why does this matter? Because the difference between these two forms can swing your price tag by tens of thousands of dollars a year. Let's look at an example. I want to tell you about a parent named Jennifer. Jennifer is a marketing consultant in San Jose. She and her husband make a combined $160,000 a year. Now, that is a good income, but in the Bay Area, with the cost of living, they definitely don't feel rich. However, they bought their house 15 years ago, and thanks to the real estate boom, they are sitting on about $700,000 in home equity. So, Jennifer fills out the FAFSA. The federal government looks at her income, ignores her home equity because the FAFSA doesn't look at your primary home, and says, okay, your student aid index is $42,000. That's what the government thinks she can pay. But then she applies to a prestigious private college that requires the CSS Profile. They look at the income, sure, but they also look at that $700,000 in home equity. Suddenly, that school comes back and says, actually, we think you can afford to pay $79,000 a year. Same family, same income, same bank account, but the price tag almost doubled just because the school used the institutional methodology instead of the federal one. I want you to pause and reflect on that for a second. Why might a college's definition of your ability to pay be so drastically different from the government's? It comes down to intent. The FAFSA is trying to distribute federal Pell Grants and loans. They want to encourage homeownership and small businesses, so they often exclude those assets. But the CSS Profile schools are deciding how to give out their own money. their endowment funds. And before they write you a check, they want to make sure you have absolutely no other stone left unturned to pay them first. So how does knowing this change your perception of a college's sticker price? It means the sticker price is irrelevant until you know which formula is being used to calculate your discount. If you are a family with high assets, like home equity or a small business, but moderate income, you might be a FAFSA millionaire, but a CSS pauper. You need to know where you stand. So here is your call to action for this segment. I want you to take 10 minutes today. Go to the financial aid websites of your students' top 3 target schools. Look for a section usually called How to Apply for Aid. You are looking for one specific thing. Do they require only the FAFSA, or do they require both the FAFSA and the CSS Profile? If you see CSS Profile, put a big red asterisk next to that school on your list. That is a signal that they are going to look much deeper into your financial life than the others. Now, I mentioned Jennifer's house and how that home equity caused her expected contribution to skyrocket on the CSS Profile. That brings us to a critical trap that catches so many families in the mass affluent bracket. We call it the asset trap, specifically how your house and your small business can make you look wealthy on paper, but leave you cash poor when the tuition bill arrives. Let's dive into that. All right, so we've just established that there isn't just one price tag for college. We've got the federal methodology, that standardized tax return style calculation, and the institutional methodology, the deep dive financial audit used by private schools. But here is where the rubber really meets the road. What exactly are those elite private colleges digging for that the federal government ignores? Why does the price tag swing by $40,000 or $50,000 for the exact same family? That brings us to our next major topic, and honestly, this is the one that catches the most parents off guard. I call it the asset trap. This is that frustrating reality where you look wealthy on paper because you own things like a house or a business, but your bank account says otherwise. You are technically rich, but functionally cash poor. And how the colleges treat those assets depends entirely on which rulebook they're using, FAFSA versus CSS Profile. Let's start with the biggest asset for most of us, your home. We call this the home equity divide. Here is the good news. Under federal rules, your primary residence is invisible. It doesn't exist. You could live in a $3 million brownstone or a modest ranch, and the FAFSA says, cool, doesn't count. They only care about your income. But the CSS Profile? They view your home equity financial aid calculation very differently. They see that equity as a piggy bank waiting to be smashed open for tuition. Now, it varies by school. Some CSS schools might be generous and cap the value they assess, say at 1.2 or 2 times your income, but others, they assess the full value. Remember Jennifer from our last segment? She had a $1.8 million home in the Bay Area. The FAFSA ignored it. But a CSS Profile school looked at her $700,000 in equity and said, hey, you've got wealth there. We expect you to use it. That is how her expected contribution nearly doubled. Now, if you're an entrepreneur, listen up, because this next part is critical. We call this the business owner's dilemma. The FAFSA actually tries to encourage small business growth. If you own a business with fewer than 100 employees, the FAFSA excludes its value entirely. 0. Whether it's worth $10 or $10 million. But when we look at small business value on CSS Profile forms, that protection vanishes. The CSS Profile asks about your equipment, your inventory, your receivables, even your goodwill. They assess that paper value as if it were cash sitting in a vault. Let's use Marcus as an example. He owns a successful HVC company. On paper, the business is valued at $3.2 million. But ask Marcus where that money is. It's in work vans, it's in HVAC units sitting in a warehouse, and it's in contracts. He can't take a work van to the bursar's office to pay tuition. Yet, the institutional methodology versus federal methodology gap meant that CSS schools treated him as multimillionaire, disqualifying him from aid, while state schools viewed him based on his modest salary. This hits the mass affluent the hardest. These are families earning good money, maybe $150,000 to $250,000, who have done the right things. You bought a house, you built a business. But because you are asset-rich and cash flow constrained, you get caught in the trap. I want you to take a second and reflect on your own balance sheet. If you own a home or a business, ask yourself, are you wealthy on paper, but cash poor in reality? How might the valuation of non-liquid assets like home equity distort your actual ability to write a tuition check? Because if you don't know the answer, you might be applying to schools that think you have a fortune to spend when you're actually just trying to pay the mortgage. So here's the takeaway. Financial aid for high-income families isn't just about your paycheck. It's about your assets. FAFSA ignores the home and small business. CSS Profile hunts them down. Here is your action item for this segment, and it's a big one. I want you to calculate your estimated home equity. That's market value minus mortgage. And if you're a business owner, estimate your business's fair market value. Write those numbers down. Those are the numbers that are exposed to the CSS Profile assessment. Knowing this exposure is the first step in building a college list that won't bankrupt you. Now, speaking of things that can bankrupt you, we need to talk about a massive change that just happened to the federal formula. If you have more than one child, you might be relying on a discount that simply doesn't exist anymore. We're going to break down the new Student Aid Index SAI and the sibling penalty right after this. I need you to lean in for this next part. Even if your assets are straightforward, even if you don't own a business or a rental property, the rule book for your income and family size just got rewritten. And for many of you listening, this is going to be the biggest shock to your financial plan. We are entering the era of the Student Aid Index, or SAI. Now, for years, we dealt with the Expected Family Contribution, or EFC. Replacing an acronym sounds like boring bureaucratic housekeeping, right? Don't be fooled. This shift, which kicked in for the 2024-25 academic year, isn't just a rebrand. It's a fundamental change in the federal algorithm that determines what the government thinks you can afford to pay. Here is the headline news, and frankly, it's a tough pill to swallow for the middle class and mass affluent. The sibling discount is gone. Let that sink in for a second. Under the old EFC rules, the logic was pretty humane. If the government calculated that your family could afford to pay $50,000 a year toward college, and you had 2 kids in school at the same time, they cut you a break. They essentially divided that number by the number of students. So your contribution was roughly $25,000 per child. It made sense, right? Your salary didn't double just because you had 2 kids in dorms simultaneously. But under the new Student Aid Index SAI, that division is gone. If your SAI is calculated at $50,000, the government expects you to pay $50,000 for the first child and $50,000 for the second child. That total household contribution requirement just jumped from $50K to $100K overnight. Same income, same house, double the bill. Let me make this real for you. Let's use Michael and Lauren family as an example. They are meticulous planners, exactly the kind of people who listen to this podcast. They had intentionally spaced their kids so their college years would overlap for 2 years. They were banking on that 2 in college discount to make the budget feasible during those heavy years. It was a smart strategy until the legislation changed. When the FAFSA Sibling Discount 2024 changes went into effect, their financial projection imploded. That financial relief they were counting on vanished. We had to completely tear down their funding strategy and rebuild it from scratch because the math simply didn't work anymore. So I want you to pause and reflect on your own timeline. Do you have children close in age? Maybe a high school junior and a freshman? Have you been telling yourself it'll be tight, but when they're both in school, we'll get more aid? This is the new reality. For need-based aid for middle-class families, the bar has been raised. The SAI assumes that if you have the resources to pay for one, you somehow have the resources to pay that same amount for 2, 3, or 4, all at once. Here is your takeaway and your homework for today. If you have multiple children, you have to pull out those spreadsheets. Revisit your long-term funding projections to account for the full SAI assessment for each concurrent student. Do not assume a discount. If you don't adjust your numbers now, you could be looking at a massive shortfall right when the tuition bills arrive. Now, I know this feels heavy. It feels like the system is tightening the screws. But before you panic, remember that while the federal form has become more rigid, the institutional side, the private colleges using the CSS profile still has some flexibility. In fact, some schools dig even deeper into your life, asking about things the FAFSA ignores entirely. And believe it or not, sometimes that invasiveness works in your favor. Coming up next, we're going to talk about special circumstances, from divorce to high medical costs and the hidden generosities in the system that might actually save you money. Stay with us. We've been talking about the FAFSA versus CSS profile as if the CSS profile is the villain because it digs so deep into your home equity and small business. And yes, it is invasive. It's asking you 400 questions compared to the FAFSA's 100. It's basically a forensic financial audit. But here's the twist. Sometimes you want the forensic accountant, because while the FAFSA is a blunt instrument, the CSS profile is nuanced. And for families with complicated lives, that nuance can actually uncover some hidden money. This brings us to our next big topic, special circumstances, specifically divorce, medical costs, and what I like to call the hidden generosities of the institutional methodology. First, let's tackle the elephant in the room for many families. Divorce. We call this the divorce penalty. If you are a divorced parent, the new FAFSA rules are actually pretty straightforward. They only look at the parent who provides the most financial support. If you're the custodial parent earning $60,000 and your ex-spouse earns $250,000 but refuses to pay for college, the FAFSA effectively ignores that wealthy ex. That's a win for you. However, the non-custodial parent CSS profile is a different beast. Most private colleges using the CSS profile will require financial info from both biological parents, regardless of custody agreements or who claims the child on taxes. I've seen families where the custodial parent qualifies for massive aid, but because the non-custodial parent does well, the CSS profile assumes that money is available for tuition. It can disqualify you from aid entirely. Does your family situation include complexities like this? It's crucial to know because if you have a wealthy ex who isn't contributing, a CSS profile school might be financially dangerous for you unless you can secure a CSS profile non-custodial parent waiver, which is rare and requires serious documentation of things like abuse or total abandonment. But, and this is a big but, let's look at the flip side. Let's talk about those hidden generosities. Because the CSS profile asks so many intrusive questions, it also sees where your money goes, not just where it comes from. The FAFSA generally ignores your expenses. It doesn't care if you have high medical bills or if you live in San Francisco where a gallon of milk costs a fortune. It just looks at the gross income. The CSS profile is smarter than that. If you have significant unreimbursed medical expenses, maybe you're caring for an aging parent or a child with a chronic condition, the CSS profile often deducts those costs from your available income. Or think about this. Do you have a younger child in private high school or elementary school? The FAFSA ignores that tuition bill. But many CSS profile schools view that as a legitimate reduction of your ability to pay for college. They see that you're already paying $20,000 a year for a younger sibling, and they might lower your expected contribution accordingly. Even your zip code matters. The CSS profile often applies a cost of living adjustment. So for the need-based aid for middle-class families living in high-cost areas like New York or the Bay Area, the CSS profile might actually judge your ability to pay more accurately and more generously than the federal government does. So ask yourself, how might the intrusiveness of this form actually work in your favor? Is your life expensive in ways the standard tax forms don't show? This leads me to my final point for this segment, the power of documentation. The FAFSA is a robot. It spits out a student aid index SAI based on a formula. You can't argue with a robot. But CSS profile schools? There are human beings in those financial aid offices. They have the authority to use professional judgment. If you can prove that your on-paper wealth doesn't match your real-life cash flow, they can override the formula. But they won't do it on your word alone. You need receipts. You need proof. So here is your takeaway and your homework for this week. If you are applying to CSS profile schools, I want you to stop thinking of your financial baggage, like medical bills, elder care, or private school tuition, as burdens. Start thinking of them as deductibles. Start gathering your documentation right now. Dig up the medical receipts. Find the tuition statements for your younger kids. Get the paperwork regarding your divorce decree or child support. If you have a special financial hardship, build a file folder for it now. You will need this evidence to appeal for more aid or to fill out the Special Circumstances section of the CSS Profile. Don't let your messy financial life be a disadvantage. Use the documentation to tell your story. Now, once you know whether you're a FAFSA family or a CSS Profile family, what do you do with that info? You need to pick the right colleges. Up next, we're going to talk about the master strategy, how to build a college list that fits your financial profile perfectly, so you aren't fighting a losing battle before you even apply. Stick around. So, we've just spent some time in the weeds, talking about the divorce penalty, medical deductions, and those hidden quirks of the financial aid system. It's a lot, right? But now I want to zoom out. I want to take all those little details and assemble them into what I call the master strategy. Because here's the hard truth. You wouldn't buy a house without knowing if you could get a mortgage, right? Yet thousands of families let their students apply to 10 different colleges without knowing if the pricing model at those schools is actually designed for a family like theirs. This brings us to our final and perhaps most critical topic today, building a list based on financial fit. Now, when I say financial fit, I'm not just asking, is the school cheap? I'm asking, does the specific formula this school uses treat your money favorably? To figure this out, you need to do a little profiling. You need to look in the mirror and decide, are you a FAFSA family or a CSS Profile family? Let's break that down using the keywords we've been discussing. A FAFSA family is typically one that looks wealthy on paper in specific ways that the federal government ignores. If you have significant home equity, maybe you bought a house in a booming market 15 years ago, or if you own a small business with fewer than 100 employees, you are a FAFSA family. Why? Because under the federal methodology, that home equity and that business value are invisible. They don't exist. On the flip side, you might be a CSS Profile family. Maybe you rent your home. Maybe you have a high income but very few assets. Or maybe you have high medical costs or siblings in private high schools. In this case, the institutional methodology used by private colleges might actually work in your favor because they have the flexibility to look at your whole picture, not just your adjusted gross income. Once you know your profile, you can look at the strategy table. If you are that FAFSA family, let's say you're like Jennifer from our earlier example, sitting on $700,000 of home equity, your college list should be heavy on public universities and FAFSA-only private colleges. These schools use the federal methodology. They won't penalize you for your house. But if you apply to a list filled exclusively with elite private schools that require the CSS profile, you are walking into a trap. Those schools will look at your home equity financial aid calculation, add it to the pot, and suddenly your expected contribution skyrockets. You're applying to schools that use a methodology hostile to your financial profile. Conversely, if you're a high-income renter, those public universities might offer you zero aid based on income alone. But a CSS profile school with a massive endowment might look at your lack of assets and give you a grant. So how do we turn this into action? First, don't fly blind. Before your student sends a single application, run the numbers. Use the Student Aid Index A estimator or the FAFSA forecaster for federal numbers. Then, roll up your sleeves and tackle the College Board's pre-application worksheet for the CSS numbers. I know it's not fun paperwork, but doing this allows you to spot the gap. If you see a $40,000 difference between your FAFSA number and your CSS number, you've just found a golden strategic insight. Ask yourself, how can shifting my application strategy toward FAFSA-only or CSS-only schools save my family over $100,000 over 4 years? And finally, ensure your list includes financial safety schools. And folks, a financial safety school isn't just a school your kid can get into. It's a school where if the acceptance letter comes, you can actually write the check without liquidating your retirement or drowning in loans. If you're a business owner, your financial safety is likely a state flagship. If you're a high-income renter, it might be a private school known for merit aid. So here is your homework, your call to action for this week. I want you to audit your students' college list. Go through every school they are interested in. Go to the financial aid page. Check if they require the FAFSA, the CSS Profile, or both. Categorize them. If you realize you're a FAFSA family but your list is 90% CSS Profile schools, you need to balance that mix. Add some schools that will treat your assets kindly. It's about giving yourself options when April rolls around. And that brings us to the end of our deep dive into the high-stakes world of college funding. Today, we peeled back the layers of the FAFSA versus CSS Profile debate, uncovering the massive difference between institutional methodology versus federal methodology. We've seen clearly that financial aid for high-income families is less about a fixed formula and more about understanding the rulebook. Whether you are navigating the asset trap, worrying about how your home equity or small business value will be assessed, or you're scrambling to adjust to the new Student Aid Index SAI reality that eliminated the sibling discount, the key takeaway is that knowledge is your leverage. Don't let the complexities of CSS Profile financial aid intimidate you. Instead, use the master strategy we discussed to build a college list based on true financial fit, ensuring you aren't paying a premium simply because you filled out the wrong form for your specific profile. Thank you so much for trusting me with your time today. If you want to see the specific strategy table we mentioned, head over to the show notes at safesimplesound.com. If this episode helped clarify your family's college planning, please subscribe and leave us a review. It really helps other parents find this information. This is Alex, signing off.